Hi everyone, this is Sasha from C's AI. Today I'm going to be talking about a question that's been on a lot of people's minds recently, which is if Carvana is a scam. And this is in response to the Hindenburg research report that was published around 10 days ago. So just to give a little background, Hindenburg Research, they're an activist investment group based in New York. What they do is take large short positions against companies and then post um, forensic research reports on the company's fundamentals, trying to expose some flaw in their financials. And Hindenburg rose to fame in 2020 when they took a very public stance against Nikola Motors, which was the electric truck manufacturer. Yeah, if you're familiar with Nikola and you know what happened, then you know that this was definitely a profitable trade for them. And so recently it seems like they're taking a new, very large short position, and now it's against a different car company. This time it's Carvana. Carvana right now is the second largest company, the second largest car retailer in the US by market cap. And what this report is claiming is that it's nothing more than a grift that's about to implode internally. So in this video, I kind of just want to explain what the key statements are in the Hindenburg report, how I perceive those statements, and then finally just give a take on, is Carvana actually doomed to fail and are the investors all at risk? Or is Hindenburg embellishing the facts a little just to try to profit on their short position? So let me start by talking a bit about Carvana over the past few years. In late 2022, Carvana almost went bankrupt due to mark-to-market inventory losses on their cars. This happened when prices started tanking on the used car market after the highs of 2020 and 2021. To avoid this bankruptcy, Carvana had to aggressively restructure and basically plan out new financial activities that were going to boost their short-term growth. And if you look at their stock price, it seems like this plan worked miraculously. They've been able to recoup pretty much all the losses sustained during that period. And what the Hindenburg report is saying is that this growth, as impressive as it looks on paper, is nothing more than a mirage. And they've been able to fabricate this image through by selling their loans as asset-backed securities to a few key financial institutions. Its main customer, Ally Financial, they were buying a lot of the oftentimes subprime loans that Carvana was generating on its site, but due to high auto delinquencies, especially in the subprime ranking, they're going up. Ally Financial is pulling back. They don't want to buy as much anymore, and Carvana is really struggling to find a new buyer who's going to fill in that gap. Another claim that Hindenburg asserted is that in order to avoid similar mark-to-market losses like they faced in 2022, they've been offloading some of their vehicles to third parties at a premium to sort of like push away, rather than, marking the losses, which would what they would normally be doing. And in other words, the basically the crux of the paper is saying that Carvana has become more of a subprime loan business than a car retailer. And in the meantime, Ernest Garcia II, who's the CEO, the dad of Carvana's CEO, Ernest Garcia III, he's been selling off over $1 billion in stock before this whole thing comes crashing down. So my take on Carvana's practice of selling off their customer loans to third-party financial institutions who are prepackaging them as asset-backed securities. Is that illegal? No, it's not an illegal practice. It's actually very widespread in the auto and home industry in the US. In fact, almost 70% of all mortgages in the country are packaged into MBS and sold off. If you look at Ally Financial themselves, they actually used to be GMAC, which is the General Motors Acceptance Corporation, which, was the company that did the same business for General Motors cars, where they were handling their loans and packaging them for financial institutions to trade on. GMAC then rebranded as Ally Financial, in which a private equity firm known as Cerberus Capital, sorry, Cerberus Capital took a 51% stake during the rebranding at the time. This is the same Cerberus Capital that's mentioned in the Hindenburg report as being the undisclosed related party that was buying up Carvana's loans now that Ally's backing out and they can't find a new buyer. It turns out that if that's the related party, then it goes back to Ally Financial as well. So that's nothing groundbreaking there. And obviously, there's a negative association with asset-backed securities and the global financial crisis. But Carvana isn't, they're not paying off ratings agencies to to rate their subprime loans as being investment grade. I think it's pretty clear to all parties involved that Carvana's loans are speculative debt securities, and the parties transacting in them are just speculating on interest rates, which is what Carvana was doing as well. And when Carvana was going all in on starting this practice of originating their loans and selling them off, interest rates were high at the time. They're around 5%, which is doubly advantageous for them. If you think about it from their perspective at the time, first you get to charge a higher rate to borrowers, and second you get to speculate that the rates will drop in the near future, which will skyrocket the value of your loans. Well, what's actually happened is that rates haven't been falling in the way that some people have expected, and subprime delinquencies on used cars are on the rise. So more people are defaulting. Nobody really wants to buy these loans anymore. They're not as valuable as Carvana predicted, and that really explains why they can't find any buyers right now. Another thing that the report mentioned is that Carvana is trying to hide this truth by extending out their loans, giving extensions on their loans, but they can only extend so long, and I don't think that's really going to change anything over the next few quarters. So yeah, the profits that they're getting from this subprime, let's just call it lending business, it's probably going to run out soon. Sure, I would wager a bet that Carvana's practice of selling off their loans isn't going to, it worked very well in the short term, but I don't think it's going to last for much longer. Um, but then you look at the claim that Carvana is more of a subprime lending business than a car retailer. I disagree with the report on that. 70% of Carvana's revenue still comes from profit on cars that are bought or sold through its online platform. If you look at it, Carvana's very legit as a car retailer. They sold around 315,000 cars in 2024 at an average profit per vehicle of around 3.5 thousand, 3,500 per car. And that's really impressive numbers, a really impressive margin. It's above competitors like CarMax. But on the other side, if you were to ask me, is Carvana fairly valued as a company, then I'd have to say no. Their valuation of around 40 billion right now doesn't align with 315,000 cars sold per year. To justify that type of valuation, I think Carvana would have to be selling, around 3 million cars annually while maintaining that same average potential profit per car. Do I think it's possible for them to increase their number of sales over 8x while maintaining the same profit margin per vehicle over the next year or two? No, I mean, I don't think anyone believes that's possible. Not even Ernest Garcia the second, which probably explains why, they're trying to sell off as many shares as they can, while they know that the stock's overpriced. Now, does this qualify as a scam or a grift? I wouldn't say so. You could ask, is Tesla worth over $1 trillion, or is Elon Musk worth over $400 billion? Logically, no, but that's what they're currently being valued at on the markets. Now, you could make the claim that the markets are not operating efficiently, and there'd be some validity to that claim for sure. But that's separate to the issue which Carvana is facing, which is that they're being valued like a tech stock despite not really being a tech stock. The only question that matters to them in that for Carvana is if the market's going to keep treating them like a tech stock, and that may or may not require Carvana taking some initiatives to position themselves as a tech leader in the automotive space, which I think would be one of the smartest moves they could do right now. Once this whole subprime lending thing starts to fizzle out. With regards to that, yeah, I agree with Hindenburg that they're just Carvana is just prolonging the inevitable at this point. They're putting out extensions, as many extensions on their loans as they can, but that can only last for so long. Once that, once the delinquencies start piling up and car prices stay, lower than usual, this that market's gonna fall apart, and it's gonna have a wider impact than just Carvana alone. So to think that Carvana is, purely just working in the subprime car loan space, I think is misleading. At its core, Carvana is still a huge and innovative car retailer. They have very high profitability margins on their cars, and I think they can scale well, which is what they've been trying to do for selling more cars. Um, but with all that said, you still have to appreciate the management, how far they've been able to bounce back from that mark-to-market bankruptcy scare in 2022. I think this is going to definitely be an adjustment to their price on them. There's definitely going to be a price adjustment for Carvana stock in the coming year, but I don't think that's like as dramatic as is being portrayed in the report. That's kind of my takeaway there. I'm curious to hear what you guys think in the comments if you agree or disagree. Anyway, that's all from me. Thank you.